Welcome to the Deep Dive. Our mission is always the same. We take a stack of dense sources, articles, research, and data, and we extract the most important nuggets of knowledge or insight, giving you the shortcut to being genuinely well-informed.
And today we are tackling a concept that I think for a lot of people feels almost too simple to need a deep dive.
The dividend.
The dividend. It sounds like basic arithmetic, right? A company makes a profit, it hands a piece of that profit to you, the shareholder. End of story.
But to stop there is to miss the entire financial story. Once we start pulling on that thread, you realize the dividend is wrapped up in layers of deeply strategic financial planning, complex international tax law,
And critical market signaling that can determine whether a stock is a solid long-term hold or, a major red flag.
That's exactly our mission. We're moving beyond the simple definition. We want to understand the intricate mechanics, the global implications, and, most importantly, the strategic role these distributions play for both the massive corporations deciding capital allocation.
And for you, the individual investor who's aiming to build sustainable wealth.
Our sources today provide a really comprehensive spectrum. We're traveling from the centuries-old history that created this payment structure,
All the way to the modern intricacies of, say, the free cash flow payout ratio and the tax treatments that can radically change the net value of your return depending on where you live.
We're looking for those deep financial aha moments that explain why some of the most consistent long-term investment strategies are built almost entirely around this recurring payment.
And you really can't discuss the dividend without grounding ourselves in history. I mean, this whole idea of regular, predictable income from pooled capital goes way back.
To the world's first recorded public company to pay regular dividends, the Dutch East India Company or the VOC.
The VOC is just a phenomenal case study in corporate longevity and shareholder return. Established in 1602, it was, for all intents and purposes, the blueprint for the modern global joint stock corporation.
And their track record on dividends is, frankly, astounding. For nearly 200 years, all the way until 1800, they consistently paid annual dividends.
Just think about that. 200 years of consistent payments.
In a world of massive geopolitical instability, wars, shipwrecks, that's truly mind-boggling. And our sources specify the rate was remarkable, too.
It was. On average, those annual payments were worth around 18% of the initial value of the shares.
18% a year.
For almost 2 centuries, it wasn't just a reward, it was a fundamental social contract. It established the core precedent that if investors pool substantial capital to fund risky long-term ventures like global trade and exploration, then those providers of capital have a right to a proportional share of the profits.
It frames the entire concept of shared ownership. That historical consistency emphasizes that the dividend structure isn't an afterthought. It's the foundational mechanism for maintaining investor trust.
And for attracting large-scale investment in the first place. You need that promise of a return.
And even back in the 17th century, the payment had to be rooted in corporate success and profitability. It wasn't a bank loan repayment. It was the legal consequence of earning a surplus.
And that naturally leads us to the core constraint that has defined corporate law for centuries.
Okay, let's unpack this, starting with the fundamental definition and, critically, where that money actually comes from in the accounting ledger. This is where we anchor ourselves to the financial source of the funds.
Exactly. The source is never just, discretionary cash lying around. A corporation pays dividends from one of 2 very specific pools of money.
Okay, what's the first one?
The first and most ideal is the current year's profit, the money the company just made.
And the second?
The second is retained earnings, which are simply profits accumulated from previous successful years that the board intentionally chose not to distribute at the time.
So it's a reservoir of past profits?
A reservoir, that's a perfect word for it. But here is the absolutely critical legal constraint, which dates back to the VOC and beyond, and which underpins corporate law everywhere.
Which is,
a corporation is usually prohibited from paying a dividend out of its capital.
you can divide the profits, but you cannot legally carve up the core structure or the assets of the business itself.
Precisely. That rule is the backbone of shareholder protection, and it is far from an academic concept. If a company were allowed to perpetually pay out its capital, it would be, in effect, liquidating itself through dividends.
You would be destroying the underlying asset that's supposed to provide future income.
Yes, you'd be killing the golden goose. This is the legal defense against predatory asset stripping, where a new owner might try to load a company with debt and just extract all the physical assets.
So that constraint still matters immensely in the modern corporate world.
It matters hugely. It protects the long-term viability not just for today's investor, but for the company itself as a going concern.
Okay, now moving to the income statement reality. We have to make clear that paying a dividend is fundamentally different from, say, paying a salary or paying rent.
It is the crucial distinction that confuses so many people who aren't accountants.
So it's not a business expense.
It is not a business expense. It does not go on the income statement as a tax-deductible line item. It is strictly a division of after-tax profits among the shareholders.
Right. So if the corporation makes $100 in profit and pays $20 in corporate tax, the resulting $80 in after-tax profit is the pool from which the dividend is paid.
That's it. And the company gets no further tax deduction for handing that $80 over.
Which is where that famous term comes from.
This structural reality, the profit being taxed at the corporate level and then the distribution being taxed again at the shareholder level, is what we call double taxation.
And we'll definitely come back to that. But first, let's look at the variety of ways these payments show up, because they are not all created equal. Companies pay on a fixed schedule, but they sometimes declare these unscheduled payments.
Right, they're called special dividends.
What exactly is a special dividend?
A special dividend, sometimes dubbed an extra dividend, is a distinct one-off payment. It's the company telling the market, look, we had a windfall this year, but don't get used to this. Don't expect this to be permanent.
What usually triggers one? Selling off a part of the business.
That's a classic reason. Selling off a major asset, winning a big one-time legal settlement, or just having a phenomenal above-trend earnings year.
So they use the special dividend to return that excess cash immediately.
Without committing the company to a permanently higher regular dividend schedule, which would be really difficult, maybe impossible to maintain in a leaner year.
That makes sense. And we should also briefly differentiate between common shareholders and holders of preference shares.
Yes. Preference shareholders or preferred stockholders receive fixed payments that are also classified as dividends. The key word here is priority.
Priority in what sense?
Their payments must be made in full before common shareholders receive a single cent. It's a contractual obligation.
So they get paid first.
Always. This priority in the payment structure is often why preference shares are viewed as a kind of hybrid between equity and debt.
Okay, let's move beyond the simple cash transfer, because the form of payment can drastically affect the immediate tax and market reality for the investor.
Cash dividends are, of course, the most common, paid in currency via bank transfer or check. It's investment income, simple as that. You own 1,000 shares, they pay 50 cents per share, you get $500 cash.
But then we get to the stock, or scrip dividends, and this is where it starts to feel a little more like financial gymnastics. You're paid out in additional shares of the issuing corporation.
And this is a crucial area of confusion for investors. Let's use the standard example, a 5% stock dividend.
So if I own 100 shares, I get 5 extra shares.
Correct. But the critical nuance, particularly in places like the U.S., is that this distribution is generally not considered includable in your gross income for tax purposes at that moment.
Why isn't it taxed? Because, as we alluded to, the underlying value hasn't actually changed. It's essentially a glorified stock split.
It is precisely that. It's an accounting shell game. The total value of the company, its market capitalization, is completely unaffected. You have the same size pie, but the company has just sliced it into more pieces.
And I own more pieces, but the total value of my holding is the same.
Right. And because there's no tangible, realized gain, the tax obligation is deferred until you actually sell the shares. Your cost basis for the original shares just gets adjusted downward to reflect the new, larger number of shares you own.
And then, the truly rare bird, property dividends, or dividends in specie.
Yeah, these are very infrequent. They involve the company paying out non-cash assets.
Like what? The company sends me a laptop.
Well, technically they could, but that's almost unheard of. Most frequently, this happens when a parent company spins off a subsidiary and distributes the shares of that new, separate company to its existing shareholders. It's an efficient way to separate business units.
I see. And lastly, there's the interim dividend.
Interim dividends are payments made before the annual general meeting, or AGM, and before the official final financial statements are prepared.
So it's a sort of advance payment.
Exactly. It usually accompanies the interim or semi-annual financial statements. It allows management to get some cash into investors' hands earlier in the financial year, and it's often used to signal confidence in the full year results before they are fully audited.
That sets the foundation for what is being paid. Now, let's shift gears and look at the actual logistics. The 4 deadlines that determine if you, the investor, actually get paid. These are the critical moments in the US-UK system that dictate entitlement.
These dates are absolutely essential because, with the volume and speed of modern stock trading, the company needs a structured way to reconcile who owns what and when the clock stops ticking.
And all 4 dates follow the board of directors' official approval of the dividend.
That's the trigger, the board meeting.
Okay, so the first date is the declaration date. What does this moment signify legally and financially for the company?
The moment the board declares its intention to pay, it's no longer optional. It's a legally binding decision.
So a liability is created.
A legal liability is immediately created on the company's books. They now officially owe that money to their shareholders. It moves from a possibility to a concrete short-term debt obligation on the balance sheet.
Then we hit the second date,
Yep.
the most confusing and arguably the most crucial for the active investor, the ex-dividend date. What does X actually mean, and why is this the deadline?
Ex-dividend literally means without the dividend. This is the market cutoff. If you buy shares on or after this date, they no longer carry the right to receive the recently declared dividend.
You are buying the stock ex-dividend.
Correct. The seller of the stock on that day still gets the dividend, not you, the buyer.
So just to be crystal clear, if I buy a share the day before the ex-dividend date, I get the payout,
Yes,
even if I sell the share 5 minutes later on the ex-dividend date itself.
that's absolutely correct. Your ownership before the cutoff is what grants you the right. The key is the settlement time. In the US and Europe, the ex-dividend date is typically set 1 trading day before the 3rd date on our list.
The record date.
Yes, the record date. And that 1-day gap is necessary to ensure that the purchase transaction formally settles in the company's books before they finalize their list of who gets paid.
Which brings us to date number 3, the record date, or book closure date. This is where the company actually draws the line.
This is the moment the ledger is frozen. The company takes a snapshot. Shareholders who are officially registered in the company's record as of this specific date will be paid.
And if your purchase settled before the ex-dividend date, you will automatically be on this record.
Automatically. The term book closure date is a bit of a holdover from when they would physically close the share register for a few days to finalize the list. Now it's all electronic, of course.
And finally, the moment everyone's waiting for, the payment date.
The payment date is simply the day the cash moves. The company distributes the funds, either mailing a check or, far more commonly these days, sending a direct credit to your bank or brokerage account.
Okay, we have to address the fascinating market adjustment that happens on the ex-dividend date. This is the notorious ex-dividend drop. Why should the share price drop, and by how much?
It's a reflection of pure financial reality. A dividend payment is a massive cash outflow from the company's bank account.
So the company is literally worth less.
Exactly. Its assets, specifically cash, decrease. Therefore, the company's intrinsic value decreases proportionally. So traditionally, you expect the share price to decrease by an amount roughly equal to the dividend being paid.
So if the stock closed at $100 yesterday and it's paying a $1 dividend, theory suggests it should open around $99 today because a dollar of cash has just left the balance sheet for every share.
That's the starting point. It's the market adjusting for the loss of that asset. It prevents a kind of free money arbitrage where you could just buy the stock the day before, get the dividend, and sell it for the same price the next day.
Now, beyond the dates, the regularity of this income stream varies a lot by region.
Absolutely. Frequency is a cultural and regulatory norm. In the U.S., quarterly payments are the overwhelmingly common standard. It aligns really well with the U.S. quarterly financial reporting cycle.
But that's not the case everywhere.
Not at all. When you look at Japan, the UK, and Australia, semi-annual payments are much more typical. And Germany, for instance, tends to favor annual payments. This variation can significantly affect cash flow planning for global investors who are counting on that income.
Knowing when you get paid is only half the battle. Understanding how healthy and, crucially, how sustainable that payment is requires moving from basic definitions into financial metrics.
Yes, this is where we analyze dividend safety using the payout ratio.
Which is what exactly?
The payout ratio is arguably the single most important metric for a dividend investor. It quantifies the proportion of a company's profits or cash flow that is actually being distributed to shareholders.
And a high ratio isn't necessarily bad, but an unsustainable ratio is a ticking time bomb.
That's the perfect way to put it.
Yeah. Okay, so the starting point for most amateur investors is the earnings-based payout ratio. What's the simple calculation for that?
You take the dividends per share, the DPS, you divide it by the earnings per share, or EPS, and then multiply by 100 to get a percentage.
And the simple red flag here, the big warning sign.
A ratio that is consistently over 100%.
Because if the dividend per share is higher than the earnings per share,
The company is paying out more than it earned in that period. That means they're dipping into that reservoir of retained earnings, or, in the worst case, borrowing money just to keep the dividend streak alive. That is inherently unsustainable for anything beyond a brief, unusual period.
but our sources emphasize that EPS, earnings per share, can be manipulated, or at least it's subject to numerous accounting rules that don't always reflect physical liquidity.
That's the huge weakness of using EPS.
Which leads us to why the pros use the free cash flow payout ratio as the superior measure for determining true dividend safety.
This is where we move from accounting principles to cash physics. It's about what's actually in the bank.
Because earnings are an accounting concept that includes non-cash items like depreciation or amortization.
Right, but free cash flow, FCF, represents the actual physical cash generated by the business after all the necessary business maintenance and growth investments have been made.
So let's define FCF precisely for everyone.
FCF is calculated by taking the operating cash flow, the cash generated from the core business activities, and then subtracting the capital expenditures, or CapEx.
And CapEx is the money spent on things like new machinery or property.
Exactly. The money needed to keep the business running and growing. The result, the free cash flow, is the cash that is truly free to be returned to stockholders or used for major expansion.
So if the FCF payout ratio is the real litmus test, how do we calculate it?
It's the same structure as before. Dividends per share divided by free cash flow per share times 100.
I see the tension here. So a company could have high EPS but low FCF. Its earnings-based payout ratio might look safe, say 50%, but the FCF ratio might be 120%.
And that is the moment of insight. A high FCF payout ratio, especially one consistently over 100%, is the prime red flag for financial distress that often gets overlooked by people just looking at the headline EPS number.
And I imagine short sellers are looking for this exact metric.
Short sellers and activist investors specifically hunt for this discrepancy. It reveals that the company is possibly covering the dividend using unsustainable methods, taking on new debt, selling off assets, or drastically underinvesting in its core business.
So they're sacrificing long-term health for the short-term signal of a dividend payment.
Precisely. XCF doesn't lie. It's the true measure of management discipline. You either have the cash flow to cover your expenses and the dividend, or you don't.
The financial math is critical, but the geopolitical and legal reality is just as important. Navigating global tax structures can drastically change the final net return you receive.
Oh, absolutely. Governments treat dividends as a major source of revenue, and they use tax policy not just to collect money, but also to protect corporate viability and incentivize certain behaviors.
The core dilemma is the one we already identified. Corporate profit gets taxed at the company level.
And then the distribution, the dividend, is often taxed again at the shareholder level.
This brings us squarely to the infamous double taxation problem, which defines the system in major markets like the US and Canada. Walk us through how that works in practice.
Okay, in a pure double taxation system, let's say company A earns $100. The corporate tax rate is, say, 25%. So the company pays $25 in tax, leaving $75.
And that $75 is then distributed as a dividend.
Right, to shareholder B. Now, shareholder B is taxed on that $75 at their personal income tax rate. Let's call it 30%. So the same initial $100 of profit has been taxed twice, first at the corporate level, then at the personal level.
To mitigate this, both the US and Canada impose a lower tax rate on qualified dividend income compared to ordinary income like your salary.
It's a concession. It softens the blow, but the fundamental structure of dual taxation remains.
And this stands in stark contrast to the imputation system used in places like Australia and New Zealand.
A system that is structurally designed to eliminate that double taxation completely.
This is a really sophisticated solution. Tell us how the imputation system works, specifically using these things called franking credits.
Okay, so let's take that same Australian company that earns $100 profit. The Australian corporate tax rate is 30%. So the company pays $30 in tax and has $70 left.
Simple enough so far.
Now, when it distributes that $70 dividend, it attaches a franking credit equal to the $30 in tax it has already paid.
Okay, so the shareholder gets $70 cash and a $30 tax credit. How do they use that credit?
When the shareholder files their taxes, they declare the full $100, the grossed up amount, as their income.
Not just the 70 they received.
No, the full 100. Now, if their personal marginal tax rate is, say, 19%, they would owe $19 in tax on that $100 of income.
But they have the $30 credit.
Exactly. They use the $30 franking credit to offset their tax liability. Since the credit of $30 is higher than the $19 they owe, they actually receive an $11 cash refund from the government.
Wait. So the Australian shareholder can actually get a refund from the tax office simply because the company's tax rate was higher than their personal tax rate.
That's right. It changes everything. It means the profit is only taxed once, and it's always taxed at the shareholder's personal marginal rate. It's a massive incentive for domestic investment.
That's fascinating. Now let's look at India, which provides a great example of rapid policy evolution. They shifted from taxing the company to taxing the shareholder.
Yes. For many years, India used something called the corporate dividend tax, or DDT. The company paid the tax on the distribution, and the dividend was then tax-exempt in the hands of the shareholder.
Which seems simpler, administratively.
It was simpler for the tax authority, but it was often inequitable. A very wealthy investor and a low-income investor effectively paid the same tax rate on the dividend, which was the rate the company paid.
And the policy reversal.
Since the 2020-2021 budget, the DDT has been abolished. India moved to a classic system where dividend income is taxed directly in the hands of the investor based on their individual income tax slab rates.
Which aligns better with global standards and makes the system more progressive.
Right. It ensures the tax burden is distributed based on the investor's personal income level.
Moving to the UK, their regulatory framework is governed by the Companies Act 2006, and it provides some very specific legal guardrails around distribution.
Part 23 of that act is key. It explicitly states that a company can only make a distribution, which includes dividends, out of its accumulated realized profits, less any accumulated realized losses.
That emphasis on the word realized seems really important from a legal standpoint.
It's everything. It prevents companies from paying dividends based on, paper gains or anticipated future success. The profit has to be real and in the bank, so to speak.
And there was a court case that really hammered this home.
Yes, the 2018 judicial clarification in a case called Global Corporate Ltd v. Hale. In that case, certain payments that had been treated as expected dividends were later deemed unlawful when the company hit financial distress and went into liquidation.
So the court said that even though the money had been paid out, the dividend was invalid because the profits weren't truly realized and accounted for legally at the time.
Exactly. The directors were held liable. It underscores the need for robust corporate accounting and transparency. And it's also why the UK government reviewed the rules following concerns that distressed companies were pushing out large dividends despite having very precarious finances.
And they proposed what? More disclosure.
A requirement for the largest companies to publish a formal distribution policy statement just to increase scrutiny on management decisions around dividends.
Okay, before we move on, let's just lock down the critical tax distinction that confuses new investors. The difference between a dividend and a capital gain.
This is fundamental to strategic investing. A dividend is a share of profits. It's taxed immediately upon receipt or reinvestment.
Whereas a capital gain is.
A capital gain is the profit you realize when you sell an asset, like a stock, for more than you bought it for. That is taxed only at the time of sale and often at preferential, lower capital gains tax rates.
And the tax timing is crucial. Let's take the example of a stock buyback where a company uses cash to repurchase its own shares. A non-selling shareholder sees their stake increase proportionally and likely sees a rise in the stock price.
But that potential gain isn't taxed yet. The tax is deferred until the shareholder chooses to sell their shares.
And that tax delay, the ability to choose when you realize the gain, is often a major reason why management teams opt for buybacks over dividends.
Absolutely. It can be much more tax efficient for long-term holders in those double taxation jurisdictions.
This complexity leads directly into the biggest debate in corporate finance. Is paying a dividend a strategic genius move or a sign of managerial stagnation?
It's the tension between returning capital to shareholders now versus retaining and reinvesting that capital for exponential future growth. It really defines the difference between a value stock and a growth stock.
Let's revisit the stock price drop on the ex-dividend date, because the simple cash left the building theory needs to be refined by tax reality.
The full $1 for $1 drop is the traditional starting point. But in reality, markets are sophisticated enough to adjust for the tax implications.
So academic models suggest the price drop should reflect the after-tax value of the dividend.
Right, adjusted by the difference between the capital gains tax rate, let's call it TANIKI, and the dividend tax rate, $10.
Let's walk through the specific example our sources provided, because this is where the financial theory gets really interesting. Let's assume the dividend is £1, and we have a high capital gains tax rate, say 35%, and a lower dividend tax rate of 15%.
Okay, so if you receive the £1 dividend, you pay 15% tax on it, leaving you with 85 pence net cash in your pocket.
Got it.
Now, for the market to be indifferent, for you to get the same net value from the price drop as you did from the dividend, the capital loss must be equivalent to that 85 pence after you account for the tax savings on that loss.
So we need to find the pre-tax capital loss that, after saving 35% on taxes, gives you a net benefit of 85 pence.
Exactly. So the required pre-tax price drop is calculated by dividing the after-tax dividend, the 85 pence, by 1 minus the capital gains tax rate.
Which is 1 minus 0.35, so 0.65.
So you take 0.85 and divide it by 0.65, which comes out to about £1 and 31 pence.
Wow, so a £1 dividend could theoretically cause the stock price to drop by £1.31. Why?
Because in this specific scenario, a capital gain is taxed more heavily than a dividend. So for you to obtain the same net benefit from a capital loss, the pre-tax loss has to be larger. It's the market trying to find an after-tax equilibrium.
That is extremely complex, and it confirms that the specific tax regime heavily influences market efficiency around these dividend payments.
It really does. However, we have to stress the institutional factor. In jurisdictions where the market is dominated by large institutional investors, pension funds, endowments that often pay zero or very little tax on dividends,
Right.
the price drop tends to adhere much closer to the full one-for-one amount because the primary driver of the market price isn't the taxable individual investor.
And as we noted earlier, this is all theoretical. In reality, the stock market is volatile, and the stock may open higher or lower due to general market forces, completely ignoring this.
Absolutely. The theoretical adjustment just tells us what an efficient market should do, but supply and demand often override academic perfection on any given day.
Now, on to the great debate, payout versus reinvestment. The primary criticism against paying dividends often comes from the growth camp. What is their central argument?
Their argument is simple. Capital should be retained and reinvested in the business. If the company can generate a higher return on equity by investing in R&D, new facilities, or expansion, an internal rate of return of, say, 20%.
Why should they return that cash to shareholders who might only reinvest it elsewhere for 7%?
Exactly. They argue that paying a dividend is a tacit admission that management has run out of good ideas.
That sounds logical for a high-growth startup, maybe a tech company. But what about established cash-rich firms?
And that's where the counterargument comes in, championed famously by investors like Peter Lynch.
The legendary Fidelity manager.
Yes. Lynch was highly skeptical of cash retention. He argued that companies that perpetually avoid dividends often have a sorry history of blowing the money on a string of stupid diversifications.
Diversification, I love that term. That's a powerful point about management discipline. Cash is easy to burn if the board lacks focus.
It's a mechanism for discipline. Forcing the company to pay out cash imposes a check on management's tendency toward empire building or making poor acquisitions just because they have a large cash cushion burning a hole in their pockets.
And if we look back at the foundational philosophy of value investing, Benjamin Graham and David Dodd were extremely prescriptive in their 1934 text securities analysis.
They were. They asserted that the prime purpose of a business corporation is to pay dividends to its owners.
That's a pretty strong statement.
For them, a successful company must not only pay dividends regularly, but actively increase the rate over time. They saw the dividend as the ultimate validation of the company's financial success.
How do you square that circle, though? How do you square Graham and Dodd's philosophy with the explosive returns from companies like Amazon or Tesla, which have deliberately avoided dividends for decades to fund massive expansion?
It depends entirely on the company's life cycle and its opportunity set. Graham and Dodd were speaking to mature industrial-era companies where exponential growth opportunities were finite.
Right.
For a highly disruptive tech company in a market with infinite scalability like Amazon in the late 90s, reinvesting every single penny back into infrastructure and market capture was the highest possible return on that capital.
But once a company matures and market penetration slows,
The philosophical shift back towards returning capital, either through buybacks or dividends, becomes imperative. The key is efficient capital allocation, not just the existence of the dividend itself.
that distinction is crucial. Now let's look at the data supporting the dividend side, the evidence for outperformance.
The evidence, particularly in developed economies over long periods, is pretty compelling. Multiple studies consistently show that dividend-paying stocks as a group tend to offer superior total long-term returns relative to the overall market.
Better than the S&P 500 or the Dow Jones.
Yes.
Why does this outperformance persist? What are the mechanisms our sources propose?
There are four key explanations that seem to work in tandem. First, dividends are often associated with a category we call value stocks.
And value stocks, over long cycles, have historically outperformed the sexier growth stocks.
That's the first part. Second is stability during stress. Dividend payers tend to be more durable during market crashes or bear markets. They fall less because that ongoing cash payment provides a kind of floor or a psychological anchor for investors.
Okay, what's the third reason?
The signal itself. A consistent rising dividend is a potent signal of financial discipline. It indicates a profitable company with high levels of free cash flow, as we discussed earlier, and a management team that is committed to shareholder returns, not just spending.
And the fourth reason links back to Peter Lynch's diversification point.
It does. They often represent mature, fundamentally sound companies that are simply unfashionable or overlooked by the media and the high-speed traders. So investing in these steady performers becomes an effective, often contrarian strategy that avoids the volatility and overvaluation of the high flyers.
Asset managers seem to treat the cash dividend as a kind of verification mechanism, a way to cut through the accounting fog.
Absolutely. Asset managers are constantly worried about earnings management or the legal and sometimes illegal manipulation of reported earnings. But cash is cash. You can't fake it.
So the ability to pay a sustained, increasing cash dividend is seen as the clearest positive signal of a company's underlying financial health.
And the genuine quality of its earnings. If they can pay it in hard cash, the earnings are probably real.
And Professor Jeremy Siegel's research seems to be the final word on this.
Siegel's long-term data found a really powerful conclusion. Stocks that don't pay dividends as a group generally perform worse over the long term than the overall stock market average, and certainly worse than the group of dividend-paying stocks.
So the data strongly suggests that for most companies, avoiding dividends is more often a warning sign than it is a growth engine.
That's what his research shows, yes.
So if dividends are a good thing and a sign of corporate discipline, the next logical question for the investor is, how do we strategically leverage them? This brings us to the power of dividend reinvestment plans, or DIPs.
DRPs are the turbocharger for long-term dividend investing. The core mechanism is really simple. Instead of receiving the cash dividend directly into your account,
The money is immediately used to buy additional shares of the underlying equity.
that's it.
The key benefit is compounding on steroids, essentially.
It allows the investment return to be compounded exponentially and often with extreme efficiency. Many company-sponsored DRPs are either free or charge only minimal administrative fees.
Which means you avoid the brokerage commission you would normally pay to buy small amounts of stock.
Right. And critically, DRPs often allow you to buy fractional shares, ensuring every single penny of the dividend is put back to work instantly.
And this mechanism perfectly facilitates the powerful long-term strategy known as dollar cost averaging.
That's exactly right. Dollar cost averaging, or DCA, is the practice of investing a fixed amount of money at regular intervals. It naturally mitigates risk by removing emotional timing from the equation.
And in a DRP, the dividend payment becomes that set amount.
It does. When the stock price is low, your reinvested dividend automatically buys more shares. When the price is high, it buys fewer. It's an automatic, passive way to engage in sound long-term investing behavior.
Now, we must address the absolute crucial tax caveat that trips up many DRP investors, especially those used to non-taxable accounts like 401k or an IRA.
This is paramount for investors who are doing this in a taxable brokerage account.
Hmm.
You must still pay tax annually on the dividend income, even though you never receive the cash.
So the tax authority treats that reinvestment as if you received the cash and then immediately used it to purchase stock.
Exactly. So you must have other cash available to pay the tax bill on money you never physically held. It's a phantom income problem.
DRPs also often come bundled with other useful features, such as optional cash purchases or OCPs.
OCPs, or sometimes called share purchase plans, allow investors enrolled in the DRP to make periodic voluntary cash investments in the stock outside of the scheduled dividend payment.
And you can invest small amounts.
Usually, yes. They're often subject to minimums, maybe $25, and very high maximums, perhaps $100,000 per year. If the plan is low cost or free, it's an incredibly cost-effective way to build up a position over time.
And a variation on this is the Direct Stock Purchase Plan, or DSPP.
DSPPs are the true entry point. They allow the initial share purchase to be made directly through the plan, bypassing the need for a retail brokerage account altogether. This is crucial because traditional DRIPs usually require you to already be a shareholder to enroll.
A point of friction for investors is the distinction between a registered shareholder and a beneficial shareholder in the context of DRIPs.
Right. Most company-sponsored DRIPs require you to be a registered shareholder. This means your name is listed directly on the company's books with their transfer agent as the legal owner.
And a beneficial shareholder.
That's how most people own stock. You hold it indirectly through a proxy, a broker like Fidelity or Schwab. Your broker holds it in street name for your benefit.
So if you hold shares through a broker, you can't use the company's official DRP.
Typically not. You have to use what's called a synthetic DREP offered by that brokerage firm. They handle the reinvestment for you.
And what's the main drawback, the major administrative pain point of using those company-sponsored DRAPs that often deters investors?
It is, quite simply, the record keeping. It is a substantial, often overwhelming administrative burden when it comes time to file your taxes or sell the shares.
Because you have to track the cost basis, the exact price paid for every single one of those tiny automatic purchases.
Every single one. If you are participating in 15 different company DREPs and those companies pay quarterly, you could accumulate over 600 separate share lots over a decade.
That's the nightmare scenario. You need meticulous records to accurately calculate your capital gains tax when you eventually sell.
And this complexity is exponentially worsened if the company has corporate events like stock splits, mergers, or spin-offs, requiring you to adjust the cost basis manually for hundreds of tiny transactions.
I can see why a broker synthetic DR8 might be preferable, even with its limitations.
The synthetic DRP handles all that record keeping, which is a huge benefit. The major drawback, however, is that brokers typically do not allow those optional cash purchases within that plan.
So if you want to invest more cash than just the dividend amount, you have to execute a separate transaction and pay a commission.
Usually, yes. It's a trade-off between convenience and features.
We've focused heavily on joint stock companies, but the concept of profit distribution exists in other corporate entities as well. Let's look at cooperatives.
Cooperatives operate under a completely different principle. They allocate dividends not based on the value of a member's shareholding, but based on the member's activity with the co-op.
Which radically changes the nature of the payment.
And its tax treatment. Co-op dividends, often called patronage dividends or patronage refunds, are usually treated as a pre-tax expense for the co-op itself.
So it's more like a customer rebate or a staff bonus?
Exactly. It's deducted from the turnover before the final profit is calculated, which means the profit is often taxed only once at the member level.
Can you give us a tangible example of that in action?
Sure. In a consumer's co-op, like a retail store, the dividend might be a percentage return on your total annual purchases. For a worker cooperative, the dividend is allocated based on contribution, like the hours you worked. And for a credit union, the dividend is structured as interest paid on a member's deposits.
Finally, we have trusts, specifically real estate investment trusts, or REITs, and royalty trusts. Their distribution patterns often seem to defy logic by consistently exceeding their reported accounting earnings.
Yes, this confuses a lot of investors.
How is that possible and sustainable?
This phenomenon happens because standard accounting earnings often don't capture the underlying economic realities of these asset-heavy businesses. For a REIT, the economic value of its real estate holdings may be appreciating faster than the accounting depreciation. They have cash flow, even if the accounting profit is low.
But if they pay out more than their actual earnings, doesn't that become a problem?
It does, and it has a specific name. If the distribution exceeds the recognized income, the excess portion is treated as a return of capital.
What does that mean for the investor?
It essentially shrinks the book value of your asset. That return of capital may be taxed differently from a true dividend. Often it just reduces the cost basis of your original investment until that basis hits zero. After that, any further payments are taxed as capital gains.
And a quick note on mutual insurance.
Right. Mutual insurance companies, which are owned by their policyholders, distribute what they call dividends to participating life policyholders. These are generated by the investment returns of the insurer's general account. That distribution can be used to decrease future premiums or to increase the policy's cash value.
This has been a true deep dive into what we initially thought was a simple distribution of cash.
Here.
Let's bring it all back together with our key takeaways.
First, we establish that the dividend is fundamentally defined by history and law as a distribution solely from accumulated realized profits, never from the company's core capital.
We dissected the critical distinction between the 4 dividend dates: declaration, ex-dividend, record, and payment, which every investor must understand to secure their entitlement.
We emphasize the strategic importance of using the free cash flow payout ratio to assess dividend safety, recognizing that cash liquidity is a far better indicator of sustainability and management discipline than accounting earnings alone.
We explored how global tax systems, especially the complexity of double taxation versus the efficiency of the imputation system in Australia, drastically alters the investor's net return and must be a central factor in portfolio construction.
And we analyze the long-term evidence and the philosophy of giants like Graham, Dodd, and Lynch, confirming that the dividend is a strong signal of corporate discipline that often leads to superior market performance.
Finally, we detail the powerful compounding strategy offered by dividend reinvestment plans, or DRIs, and highlighted the necessary diligence required to manage the unique tax implications and complex record-keeping that comes with automating wealth creation.
So what does this all mean for you, the learner? I think the key is that dividends are not just a stream of passive income. They are the most tangible, verifiable signal of management confidence and corporate health available to the public investor.
A signal validated by centuries of financial history.
Exactly. And the strategic key is moving beyond the simple definition. Recognizing unsustainable payouts, using that FCF ratio, understanding how tax changes your net value, and actively using the DRBA mechanism to turn that consistent cash flow into an efficient, compounded wealth-building machine.
That brings us to a final provocative thought, tying back to the legal framework. Historically, courts in common law jurisdictions gave directors wide discretion over dividend policy. It was seen as a management decision, not a shareholder right.
The courts didn't want to second-guess the board.
Right. But in 2013, the Supreme Court of New South Wales recognized a shareholder's contractual right to a dividend in a specific commercial case, Sumiseki Materials, Co. Ltd v. Wambo, Co. Bidi Ltd.
That decision essentially chipped away at the long-held tradition of director immunity in this area.
Exactly. So, for your ongoing exploration, consider the implication of this legal shift. If courts begin to enforce a contractual right to a dividend, especially in jurisdictions where companies are holding vast cash reserves on their balance sheets,
What pressure does this put on corporate boards?
does this open the door for increased shareholder litigation demanding cash payouts? Does it fundamentally alter the power dynamic away from management's desire for retained earnings and back toward that foundational Graham and Dodd philosophy of returning capital?
It's a huge question that could redefine capital allocation in the coming decades. Food for thought indeed, as the legal landscape catches up to shareholder expectations.
That's all the time we have for this deep dive. We hope you feel thoroughly informed on the mechanics, strategies, and global complexities of the dividend.
Until next time.